Hello everyone, my name is Brynn Fitzpatrick and I will be discussing how the U.S. economy changes during a presidential election. Elections are pivotal moments that not only determine political leadership but also have profound implications for economic policies and market dynamics. In this video, we'll explore the multifaceted relationship between presidential elections and the U.S. economy, drawing insights from historical data and recent analyses. Historically, presidential elections have been associated with varying economic outcomes. For instance, the stock market often experiences increased volatility during election years due to uncertainty about future policies. According to a study by The Conversation, while markets may react to election outcomes, the long-term economic impact is more closely tied to the policies implemented by the elected administration rather than the election itself. A great example of how long-term economic impact depends more on actual policies than the election itself is the Tax Cuts and Jobs Act passed under President Trump in 2017. While the 2016 election created short-term market reactions, it was the implementation of this major tax reform that had real long-term economic effects. The corporate tax rate was reduced from 35% to 21%, which directly boosted after-tax profits for U.S. companies. Many firms responded with stock buybacks and investment expansions. The GDP growth rate accelerated temporarily in 2018, and unemployment dropped to historic lows. Policy uncertainty during election periods can influence economic behavior. Businesses may delay investment decisions, and consumers might postpone significant purchases until there's clarity on future policies. A CNN article highlighted that in the lead-up to the 2024 election, economic uncertainty contributed to a slowdown in business investments and consumer spending, underscoring the tangible effects of political ambiguity on economic activity. In both the 2020 and 2024 elections, major corporations delayed capital expenditures. This included things such as buying equipment, expanding factories, or hiring new workers. They did this because they were unsure if tax rates, environmental rules, or trade tariffs were going to change, which caused many businesses to be cautious. Homebuyers in swing states such as Arizona and Pennsylvania were hesitant to buy mid-2024. Mortgage applications then dipped in October. This was caused by the uncertainty around interest rates and inflation, especially by first-time buyers unsure about job security or future home values. During the run-up to the 2012 and 2020 elections, some large employers, especially in the healthcare and finance industries, paused hiring due to uncertainty about regulations like Obamacare and tax reform. This occurred due to firms not wanting to bring in new employees if policy changes might increase their labor costs and change demand for their services. The U.S. presidential election doesn't just affect domestic markets, it has global repercussions as well. The World Economic Forum noted that in 2024, the election outcome was closely watched worldwide, with potential implications for international trade agreements, global markets, and diplomatic relations. For example, shifts in the U.S. trade policies can influence global supply chains and economic stability in other countries. An example of this can be Trump's U.S.-China trade war taking place from 2018 to 2020, where the U.S. imposed tariffs on over $360 billion worth of Chinese goods, and China retaliated with tariffs on $110 billion worth of U.S. goods. This war affected other countries, as Germany and Japan both saw exports slow down due to global demand falling in response to rising costs and uncertainty. Analyzing the 2024 election provides insights into the election economy nexus. After the election, NPR reported that markets responded to the anticipated policy changes of the incoming administration. The immediate economic effects included fluctuations in stock prices and adjustments in investor expectations, reflecting the market's attempt to price in the new policy landscape. We saw this in 2016 when Trump was first elected president. Dow Jones futures dropped more than 900 points at one stage overnight. Along with this, S&P 500 and NASDAQ futures were down over 5%. Stock markets are particularly sensitive during election periods. Historical data suggests that markets tend to be more volatile in the months leading up to an election. However, post-election, markets often stabilize as policy directions become more clear. It's important to note that while elections can cause short-term market movements, long-term trends are more influenced by economic fundamentals and policy implementations. A prime example of when stock markets became sensitive during an election period was seen in the 2020 U.S. presidential race between Joe Biden and Donald Trump. In the weeks leading up to Election Day, markets were highly volatile. Investors were unsure how a potential Biden presidency would impact corporate taxes, green energy policies, and tech regulation. Despite this uncertainty, the markets rallied after Biden's win was confirmed. The S&P 500 jumped over 7% the week after the election, marking its best post-election week since 1932. Investors responded positively to the likelihood of political gridlock with a Democratic president but a likely Republican Senate, which meant fewer extreme policy changes. This shows that markets don't just react to who wins, but to what kind of government that victory creates, especially whether it brings clarity or more uncertainty. Economic conditions can also influence voter behavior. High unemployment rates, inflation, or economic downturns can sway public opinion and impact election outcomes. However, strong economic performance may support the incumbent's chances of re-election. Understanding this is crucial for comprehending how economic realities shape political landscapes. A strong example of how economic performance can support an incumbent's re-election is President Obama in 2012. When he took office, the U.S. was in the middle of a Great Recession, but by the end of his first term, the economy had made a clear recovery. Unemployment dropped from 10% in 2009 to under 8% by 2012. Over 4.5 million private sector jobs were added. The stock market had also rebounded significantly, with the S&P 500 up over 60% since 2009. These improvements helped boost public confidence in Obama's leadership. Voters who felt the economy was improving were more likely to support the incumbent, and that economic momentum played a key role in his successful re-election. In conclusion, the relationship between U.S. presidential elections and the economy is complex and multifaceted. Elections introduce policy uncertainty that can affect economic behavior both domestically and globally. While markets may react to election outcomes, the long-term economic impact is more closely tied to the policies enacted by the elected administration. Understanding this dynamic is essential for stakeholders ranging from investors to policymakers.